So you mentioned tax planning and things like that. What are some steps that physicians can do to sort of limit their tax burden?
So there's a couple of things that you can do there. I'll go back to the retirement plans. The easiest thing to do is to maximize what you're putting into your qualified retirement plan, because to the extent that you're making a tax deductible contribution, that reduces your taxable income. The money grows tax deferred. Now, when you take it out at retirement, it will be taxable income to you, but presumably you would be in a lower tax bracket at that point. But at least in the interim, that is a very nice tax deduction. You also want to make sure that you are investing in tax efficient vehicles. So once you've maximized your retirement plan, to the extent you're doing investing outside of that, you want to make sure that those investments have the highest return possible on an after-tax basis. So that would be things like consider municipal bonds, for instance, in your portfolio. Consider treasuries, both of which have some tax advantages. Consider ETFs in your portfolio. Those are exchange traded funds. ETFs do not distribute capital gains like actively managed mutual funds do, so you really can control the tax treatment. You don't pay capital gains taxes until you actually sell the ETF. So consider those kinds of things. And then to the extent you have actively managed mutual funds in your portfolio, try to pick funds that have as a stated objective tax sensitivity. Some funds actually will state that as an objective, that they're trying to be tax sensitive. And if you use that as one of your screens, that can be beneficial as well. So if you construct a portfolio outside of retirement plans that's going to be taxable, make sure that you're maximizing your after-tax return, and make sure you're working with an advisor that understands that and has that as one of the objectives when they're constructing the portfolio for you.